One of my great sponsors is KeyCity Capital, and you can read all about it at keycitycapital.com/Hugh. But whenever I invite the head of KeyCity Capital on, Ty Lasater, I always disclose I'm an investor with KeyCity Capital because I'm an accredited investor. You cannot get into the fund that I invested in 2 years ago with the Fetching Mr. Hewitt. And before you invest with KeyCity Capital, no matter how great it sounds, read the prospectus and make your own decision before doing that. Ty Lasater, good morning. I wanted to talk to you about interest rates and apartment vacancies. I talked to Andrew Del Rey yesterday at length. People can't buy houses. You're in the apartment business right now. You must be in the sweet spot.
Yeah, well, it's still a tough spot just with the housing market across the United States and with what we're seeing in inflation and everything. But at the end of the day, people can't afford homes like they used to. And the American dream that once was is getting further and further out of reach to obtain. And people are looking for something that is safe and secure to call home, but a little bit more flexible. They don't want to be locked into that 30-year and or they just can't quite afford to. And we are focusing on that market. We focus on and we target on B and C class properties. And so we really, our product is derived directly for the workforce housing across the United States, which is the market that is getting hit the most by the inflation that we're seeing right now, by the interest rate hikes, and really by the prices of homes across the United States.
So KeyCity Capital established funds. They collect limited partners like myself and my wife. You have to be an accredited investor. The minimum investment's $100,000. They buy apartments, they manage the apartments, and then they return your capital appreciation and cash flow in the course of that. How long is the average fund's life, Ty? How long is the money tied up for?
Well, we typically follow a real estate cycle. So what we typically say is 5 years. I've done it as quickly as 2.5 years. And I've also taken as long as 7 years. And so 5 years is kind of the sweet spot. What we're seeing right now, I've got a couple of funds that I started about 3 years ago. Ideally, I was looking to start exiting those funds this year. Well, with the market that we're seeing right now, with interest rates as high as they are, people aren't buying. Home buyers aren't buying. Investors aren't buying. And so product is not moving as much. And so that one will push on a little bit and we'll wait until the real estate market turns back up. Then I've also had properties that we bought coming out of 2008 and 2009, and we held them for 2 years and we were exiting already. And so with a 5-year plan, that kind of sets the expectation that if the market starts to drive northward and you see a upward tick in the real estate market, 5 years is simple to hit. If you see a market correction in that time, you can look back over the history of the United States, and any time when the market corrected, within 5 years, the market was back above where it was when it corrected. And so that 5-year model kind of gives us a window that we can strive for as a business plan and as a goal. So when we're looking at a property, we project for 5 years, and I use market indicators within a given geographic market to help us determine what we want our exit to look like. And then we focus on 5 years, and every now and then the market dictates maybe it's a little less or maybe a little longer.
So the potential investor who's listening today, they should go to keycitycapital.com/Hugh, get the prospectus for the funds that's open, and understand, A, the fund may close before you invest, and B, you might invest with an expectation of getting your return total in 5 years, but it might be 7 and it might be 3. Did I put that right?
That's exactly right. I mean, at the end of the day, we're buying a physical asset. It's not a paperback stock. It's a physical asset. And so whenever we are looking at exiting, I'm taking into consideration everything that's going on in the market so that all of our investors can see the greatest benefit of their money. I am looking to double an investor's money in roughly a 5-year period. Real estate can have lucrative returns on it, but again, it's an illiquid asset. It's in a physical asset. And so we're looking at the opportune times to exit those assets. And so that's kind of what we look for. That 5 years gives you plus or minus right around where the sweet spot is.
And if you want to diversify into real estate and you do not know anything about REITs and you want to talk to someone that I trust, call up Ty, call up KeyCity Capital, keycitycapital.com/Hugh. That's keycitycapital.com/you. Get the prospectus. You've got to be an accredited investor and read it carefully. Talk to Ty and Steve and the whole team down there in Texas, because for Texans, they're awfully nice. How is business, by the way, Ty? Is it going strong in terms of investors?
It's going strong. It's starting to pick up a little bit. As you've seen, Jerome Powell has all but said we're going to see an interest rate drop. And so we've kind of shifted our focus, and we're buying with all cash. So as investors come in, I'm not using debt, not using leverage. It really de-risks the asset a little bit for all the investors involved, and it starts generating cash flow for those investors quicker. They can start seeing that passive cash flow a little bit quicker. But what those lower interest rates do is it opens up the market for other buyers. So in fact, this week, I've got a group of buyers coming in from New York that are looking at some of our properties in Memphis. And so I'm excited about that.
There you go. Ty Lasater from KeyCity Capital. Learn more. Go to keycitycapital.com/you. They are a sponsor. I'm an investor, but boy, I love talking to Ty. And I love KeyCity Capital. Don't go anywhere, America.